The Hedgeless Swordsman here again for the third time. It's January the 9th, 2023. Got some ideas for a new video, partly based on what I read today in the forums, and some ideas I've just planned on making a video on anyway. So first of all, I would just like to go through the simple idea of value investing. Value investing is pretty much buying something that you think is cheap, or in this, quite, let's say, risky business, you think the odds are good that it's cheap. Any stock is either, and we don't know the exact answer, we don't know the exact value of anything, we only know that in hindsight. We only know the true value of a mine or a deposit after it's been mined. And if it was never mined, it was actually zero at all times. We just couldn't know it back then, that it wouldn't become a mine in like 30 years or whatever. Anyway, so I would just like to go through the, let's say, 4 categories, if you will, of how I look at juniors. Might be better to use this one. Well, let's stick with this actually. This is a pure fixed value play, or optionality play, or what have you. Meaning that this company is not creating any value really over time. It's very mature. It has, let's say, a very advanced project. It may be a resource, maybe a feasibility study even. It's simply the value doesn't really change, except for obviously metal price swings, etc. And price will obviously change, not only because the price of gold, etc. changes, but also because sentiment changes. So you have swings in metals, and then you have even wider swings in sentiment. That's why it's so chaotic in the short to medium term. Any stock is like the possible range a stock can trade at, even though nothing really happens, or not much has happened with the actual value. I mean, it's just enormous. And that's why it's very hard to say anything about your returns or how good you are or whatever, based on the short term. Because things that have no real impact on the actual value, or price to value gap, etc., that is so volatile. I probably should make a video on that soon as well. But anyway, so this is a case where the price is fixed, or value is fixed. The only thing that changes is price, either being under, meaning it's undervalued, and by definition we assume that sometime in the future price will reach fair value. And typically what happens in a volatile sector like this is that it actually crosses beyond fairly valued and reaches overvalued before going back, and then for just a brief moment touching fair value, and then becomes undervalued. And history repeats as long as the company is around, basically, if it is indeed a trading sardine. This is more of a high octane pure growth play, where the base case is that whatever value a company has confirmed today, that will just climb higher and higher. The more time you give this company, base case is that if you give it 1 year, maybe it has reached a value of this, 2 years reached a value here, 3 years reached a value. So obviously by default it means that our base case is that the longer we just hold this stock, the more we will be up. If we hold it for 1 day, there's a 50% chance we'll be at in a loss, a red day or a green day, etc. If we hold it for 1 year, the management team might have been able to create this much additional value. If we hold it for 2 years, maybe it's up here. So one could back calculate this like, okay, if I hold it, I expect to have a 50% return per year. I mean, that's very good returns, obviously, because the value is being compounded at a 50% per year over the next, let's say, I mean, obviously typically goes something like maybe 100% first year, then maybe, I don't know, 60% and then just 20% or whatever. But let's say we just balance it out. So obviously, all else equal, if we just held the stock, the longer we held the stock, the more in profit we will be. And again, holding it for 1 day doesn't allow management team to create any value, really. Can't do much with 1 day, you can't drill a single hole. But 3 years, maybe 150 holes or 100 holes will have been drilled. And a lot of value will have been created. So the delta from value today to future value depends on how long you actually give the stock, how much time you give the management team to execute. Here we have more of a pre-discovery play. It's like, enormous risk, chance of actually making a discovery slim to none, maybe 3% at best, especially for your average junior. Maybe it will be trading here. So let's say it's a decent junior. So let's say, well, I should use this instead. Let's say price is here. So it's actually cheap based on a mathematical standpoint, because let's say it should be priced here because the actual chance of success is, well, let's say it's 5%, but it's priced like it's 3%. That might not sound like a lot, but that's, a kind of a big undervaluation. 67% undervalued. With that said, there's a 95% chance of failure. So in those cases, if you think you find a lot of early, pre-discovery plays which are undervalued, that's not my cup of tea at all, honestly, because like I've shown a lot of times, is that if there's a, let's say, 50% chance that you'll get a double and a 50% chance you'll lose everything, it's, well, fairly valued at that point. The problem with these plays, contrary to what we think for some reason, is that we believe that, for example, let's say there's a 5% chance they make a significant discovery. You would obviously need an immense reward to take a 95% chance of failure. The problem is, as we've seen, after a discovery is actually made, the stocks just tend to go up maybe 50 to 100%, sometimes more, obviously. But that doesn't, so even though it sounds great, like, hey, if they make this work, this could be a 10-bagger. Yes, in theory that is correct. In reality, it takes years to become a 10-bagger, and the only thing you might get from a discovery is a 1-bagger. And then everybody has the same information as you, and everybody can get in. Sure, they pay 100% more, but there's like, all of a sudden a 20% chance that it will become a 10-bagger from here or whatever. Here you take obnoxiously bad odds of a miracle, and the only thing you get paid for taking 95% chance of failure risk is a double. That does not reward you enough for the risk you're taking. That's why nowadays, and since I guess a few years, I'm almost completely out of pre-discovery plays, because it just dawned on me. It's like, Jesus, how dumb can I be? I've never seen a discovery story go up 1000% immediately after a discovery hole. But if they were not able to make a discovery hole, you typically see them go down 50%. So you should get a lot more than 100% in case you are correct, given the low odds to make this mathematically sound. But let's just pretend that you would almost get fairly rewarded, let's say. In that case, if there's a 95% chance of failure, you would need 20 identical stories for the balance of probabilities to be that one out of those 20 actually succeeds. That's 5% chance of discovery hole. But what also people typically do, not only do they bet heavy on pre-discovery plays, especially if they're starting out, because they think that's how you get a 10-bagger, they also bet big. Again, it's like you can just almost assume that all else equal, there's a 95% chance of a company's maiden drill program not to make a discovery hole. I mean, if you just use that as a rule of thumb, I think you'd save yourself a lot of money over the long term. Anyway, here we have the a cheap play plus an alpha play. So this is a hybrid. These are the ones I like absolutely the most, meaning that they're starting off undervalued with something of significance, let's say a resource, or in some cases even like, okay, maybe not a resource, but it's quite clear there's something there. It's like, yes, Snowline doesn't have a resource, but it's pretty obvious they at least have, maybe 5 to 10 million ounces at Valley. So even though you can't take that to the bank, and that requires more drilling, you can kind of argue that yes, there's meat already to this one, thanks to just how especially those systems work. That it's not a nuggety system. It's like you can kind of connect the dots from drill hole to drill hole, etc. But those are the ones I tend to, if I'm going big in a play, it's typically those that are starting off undervalued. So you have the price to value gap, and we assume it's just a matter of when, not if. We by default assume that, I don't know when, but price is going to reflect fair value at some point. And typically that happens, especially, when are these juniors undervalued? Obviously when sentiment is bad. When are they overvalued? When sentiment is hot. So on the way to a hot sentiment, we'll cross fair value sometime. And that's also a matter of when, because sentiment always swings up and down. But at the same time, if we have alpha potential, meaning growth, value creation, meaning that if I jumped 1 year into the future, this company would not be worth this much, it would be worth this much, and 2 years forward this much. 2 years forward this much, and 3 years forward this much. So regardless of what price really does, you have a uptrending value trend. So if price was fixed, that just means that you're going to make more and more and more money when it finally revalues to fair value. Those are the companies I really like, because already, it's like, I'm underpaying for this based on, you think fair value is here. So you'll get to fair value someday, and that might take a year, I have no idea. But that is the essence of, when somebody say something is cheap and they buy, by default that should pretty much translate to, I'm gonna wait until this price to value gap closes, meaning the risks are chronically to the upside as long as value is here and price is below value. That's what I don't get is like, and just another example. For example, high growth stories, they tend to be overvalued based on what is confirmed. It's like, example, Snowline went to, 450 million market cap, something like that, after, 8 holes or something. Obviously based on what is confirmed, that is extremely cheap, expensive, because they are not even close to a resource. And that's why you always have people, and the same was kind of for Newfound Gold as soon as they listed, at I think $1 or $1.40 or something. Everybody said it was so overvalued because they've only had one fat discovery hole, etc. But they kept drilling and hitting, and the market is typically front running such growth rate, meaning that the market kind of gets, or some people get, that hey, at this pace, even though it's overvalued right now, I expect it to have maybe doubled this overpriced price a year from now, simply because of the growth pace. So yes, you're overpaying now, but in a totally rational market, the market would know what the actual value creation pace was and would reflect that today, meaning that, hey, you're paying, let's say you pay 100 million for two just two holes into an ore body. It's like, yeah, obnoxiously expensive based on what is confirmed. But if the market knew that the more these guys drill, in 2 years it will be obvious that they have 5 million ounces. So 2 years from now, it will be valued like it has 5 million ounces. So it will be probably also priced higher than 100 million, because 5 million ounces, let's say they are good ounces, etc., might fetch a value of $1 billion, who knows. In that case, there's a price to future value gap of 900 million. So the question is that expensive today if you get a 900% return in 2 years? No, obviously that wouldn't be expensive at all. 900% over a 2-year period is like orders and orders of magnitude more than the market averages over 2 years. That problem is obviously we don't know that. That is the question, but I always get a chuckle when I see people, it's overvalued based on what is confirmed. It's like, no shit. That's how growth stocks work. They price in a future, meaning like, yeah, okay, the market or some dude understands that, hey, they're gonna drill here, here, here. So after 10 more news releases, it's gonna be obvious that this the value of this thing is a lot higher than the price I'm paying today. I'm just front running the fact that I think I know what the future value is gonna be. Anyway, so what I really like are these situations, especially these. I mean, again, if because margin of safety is so important, because you can't compound a loss. I have no problem taking, exploration risk, etc. I mean, that's the quickest pace of value creation. But I do want to. I really, really prefer knowing that, okay, if I'm buying something undervalued, that means that I have a future expected positive return. There's a very high probability someday I will make money on this position. Because if it was a pure trading sardine or value play and you paid here, that means the gravity, the magnet will be lower. Basically, you overpaid, it should go down and stay down. When you buy something that's cheap, it should someday go up and stay there. If it is both a value stock and a growth stock, that magnet will just keep trending higher. That is how, in my opinion, you capture. It's like that's the whole point of buying something cheap. But I saw today, for example, somebody in the Magna Mining room say it's like, yeah, you have to be aware of gaps, and you have to be aware of the RSI reading and the SMI, I think, slow or standard moving average or moving indicator, something like that. It's like basically like it's a truth. You have to keep that in mind. It's like I don't think I've ever bought or sold a stock simply because of what the RSI number was or what the moving average of something was. Never in 7 years. So obviously that's not true, because otherwise you can't explain, or I've been incredibly lucky. I mean, to me, that and I posted that in the chat. I mean, these are just my opinions, of course, and he can, invest, and anyone can invest and trade as they see fit. To me, that makes no sense, because it, especially in a case like Magna, because it completely misses the whole case of why Magna is special. Magna is not some trading sardine. Magna is not some overvalued FOMO stock. The whole point why I listed Magna as the best case I've seen in 7 years was because it was an extreme version of this. Extremely cheap based on what is already known in terms of resources, permits, jurisdiction, the whole thing. And they have a superb management team of some of the best Sudbury geologists around, etc., etc., and miners and mine builders, value creators. So if there's a big price to value gap simply because of what they have confirmed right now today, and I expect the value creation to be higher. Basically, what I'm saying in that case is that it's a matter of when, not if, you're gonna make money. And let's face it, 95% of people don't beat an index, and a lot of juniors are crappy and bad and should really not go up even. This one is like, yeah, this for sure, I think should really go up a lot, not just like 50% or something, but I'm talking hundreds of percent to fair value, especially down here. And I expect more value to be created. And lo and behold, we've seen some absolute monster hits recently. Obviously, that doesn't subtract value; that adds value. It's like confirms resources, firming up the resource. Maybe find new zones. Maybe they'll find the footwall discoveries, which they did a lot when they were running FNX mining. So meaning that I think again Magna is a hybrid case where it's like to sit at a profit was a matter of when, not if, because it's undervalued and the fair value is higher, so that's going to act like a magnet. I don't know when, but I'm going to make money on Magna. That was I was pretty sure on that, and that's not. You can't say that for most juniors. You can't say that for most juniors because again, also it's like it's so hard to know what the actual value is. I mean, some discoveries or deposits out there, I mean, in reality, they might never get into production. So if we knew that beforehand, obviously we would know that this stock has a value of 0 because no ounce will be pulled out of the ground. There will be no economic profit. But in case of Magna, you have two pretty much fully permitted projects. So if there was any resource pre-production that should be valuable and should reflect what the possible economic value actually is on paper, it would obviously be the ones that have the least amount of challenges to actually monetize it, go into production, and actually create cash flow, which is the only reason why ounces or pounds in the ground are valuable in the first place. And it's like, I think he said something about, well, you should always assume that these gaps will be closed. So he's like, I'm not adding because there's a gap here. I mean, it was so perfect because it's basically, I think it actually ended up at, I don't know, 126.7, something like that, but it was trading at 124 when I took it. It pretty much looks like the exact same candle. And RSI here, pretty much the same as here. So let's assume he followed his, cemented rule of every gap will be filled, and you especially don't buy when RSI is high. You sold, in my opinion, you made the worst sell I've ever seen since I started in this sector. If you follow that technical analysis trading rule. I think Magna is really cheap still, but it was just obnoxiously cheap down here. It's the cheapest stock I've ever seen. So if trading stopped you, I mean, I've actually added on the way up, but it's like, I have more shares now than I had here even. Again, I didn't do that based on trading. I didn't do that based on what the moving average was or RSI was or whatever. It's like there was such an obvious price to value gap that I thought the market will, I mean, that's your assumptions. Like this price to value gap will be closed one day. And that's an enormous gap. And obviously we're starting to narrow that gap. But I mean, I think it kind of highlights, I mean, to me, that's just absurd. It's like you're missing the whole point. These are, again, if you buy something cheap, the edge, the actual opportunity is that you know that someday you'll be in the profit. Meaning, it's like, let's say you think there's an 85% chance you'll make 100% on your money. I mean, do you realize how good of an investment that is? Even if that takes 2 years to close, that would be a great return. And if you have some alpha value creation, in this case exploration and de-risking efforts behind the scenes, towards production, in 2 years the value will actually be higher. So you'll make even more than the 100% expected, because now the gap might be an expected 300%. So I mean, to trade that, or use technical analysis in a case like Magna, for example, where the whole point is, it's a matter when, not if, and the price to value gap is just huge. To sit and trade that's like, I mean, akin to, in my opinion, okay, let's say here's like easy 200% here from here. Yeah, or let's say 85% chance that this will return 200%. Why on earth would you sell that or not buy that because of a candle? That's pretty much, if you understand the case, I mean, that's the thing. Almost nobody is an actual long-term value investor. But if you understood the case, like if this is almost an expected return of 200% easily, let's say. If you're not buying that, or you're, God forbid, selling that, well, both are equally horrible. You're saying that 200%, 85% chance of a 200% return just in the, let's say, next 2 years is not enough for me. I'm holding off. I hope that this will close so I get my 250% return or something. I mean, do you understand how greedy that is? And let's face it, assuming that's the case, they're not going to stop trading. They're going to trade all the way up. Meanwhile, I've just sat pat with my, ever-growing position. Of course, I made a lot more than any of the traders in this stock. Unless you literally trade this perfectly, or almost literally, trade this perfectly with a full position at all times. How on earth are you going to do that? Like get out of your full position at the actual top tick, and then you just got to know that this is the exact bottom tick, so you're going to get in with the full position and predict every move. It's like impossible. Nobody can do that. The risk reward came from the fact that it's a super cheap now. It's just a matter of time, and then I'm going to be up on it and they're going to create value. So the longer it takes for it to even reach this, it should go even higher because they probably created value. It's like this is what I assumed was like in the bank, and that's what my piece was all about. It's like an easy 100 to 200% return, if not more. I mean, the more I think about it, I think 200-300% is probably more accurate. And given the exploration results, we know that value is increasing at the same time. So in 6 months, it might not have a very conservative fair value of, in my opinion, 400 million. It might be 500 million or 600 million. So if the price is, 200 million today, and I expect the value to be 500 or 600 in 6 months, that's a 200% price to value gap. So is that not enough? Do I really need to try and predict every single up and down and up and down and up and down? No, that's enough for me. That's enough. 200% in 6 months. If it hasn't closed that, maybe in 12 months the value is up at 1 billion. So if it's just at 300 million in a year or 6 months, that means, okay, I have an easy 700 million gap to fill left. So that's more than 200% still. I don't get it. I don't get it. It's like if there's any stocks, in my opinion, where technical analysis is like trying to eat soup with a fork, that would be when there's a value play and alpha play in the same case, pretty much. But yeah, sure, if it's a trading sardine, yeah, I don't mind trading, but the same thing goes, and I've shown this a bunch of times. Let's see, fair value is somewhere around, I don't know, assuming factoring in dilution, maybe fair value is trending something like this, downsloping uh, because there's what's it called, dilution again. It's like, yeah, it's still super cheap here, and it was like I've said before, I have no idea when it's going to turn up, but if it's super cheap here, even if you bought here, it went down there first, still you made money just by waiting. But if you were trading this, like, this I'm gonna buy here because now it's gonna go up. Nope, down again. I'm gonna sell here because it went up. Nope. Again, value investing. The whole point of it is that you buy something cheap that you are pretty sure is gonna go up someday, one day. And if that gap is large enough, it's like if there's a 100% price to value gap, if that takes 2 years to close, and you only were in, uh, let's say, trading sardines or mature plays, there's like a 100% price to value gap, and you're like, yeah, we expect this to close within 2 years, which is a lot longer than anyone almost in this space can even wait. I mean, you would kill the market over the long term if you could compound at 100% over every 2 years. So that would be like, yeah, okay, here you think I think there's a 100% price to value gap. Sure, it goes down first, but it's like if you buy more and lower your average, you're just gonna make more money. So in the case of Magna, it's like I bought every dip. I pretty much bought, I don't know if I actually bought every red day, but it's like majority of red candles in here I added, and so far I haven't even sold. It's just I knew that, hey, if I love the price to value gap here I like it even more. And then as I get more and more comfortable with the case and just thought about it from any possible angle, it's like I don't give a crap if this is a short-term top. I think we're gonna go way higher, and it's, in my opinion, my thinking is it's a matter of when. So let's say there's an easy, let's say 100% return from here without even getting close to any overvaluation. That means that will be 100% expected return, regardless if we go from here down here first, because that just means that maybe down here the price to value gap is 150% return. That doesn't take away the fact that I think it will go to whatever. So even if I, let's say, bought here or held here because I expect 100%, it might go down 20% first before going up and netting me the 100% return from this level. But I sure as hell have no idea what any stock is going to trade tomorrow or next week or next month or whatever. I simply think that, yeah, it's like next 12 months, do I think Magna will net me a 100% revaluation from today's price? That's my base case. I think it could do more than that. Yeah, I mean, if some stuff happen, like more exploration success and people get aware of the story and grants or football discovery, etc., or some Shakespeare discoveries, yeah, it could easily, maybe it goes up 300% this year. I don't know. I just think that there's a very good probability that this will at least net me 100% more, just based on all what is known right now. Because I think fair value is at least 400 million right now. That's the only edge I'm playing, the price to value gap. And the idea that sooner or later a stock will price in fair value. And obviously can go above it. But again, that might take, it's like, let's say Bear Creek Mining was cheap here. February 2015. Not, excessively cheap. And let's say they didn't create any value. February 2015. It took a year for you to be in a profit. But it was still, let's say, 25%. I can tell you most people don't compound the 25% per year. So even though it looks kind of horrible from this short perspective, I can guarantee that if you could just capture 25% returns every year, as long as you live, you'll be a very rich man or woman. Yeah. So yeah, on like on that note is, I mean, again, you probably saw my recent video. This is fully diluted. This is Jason's pledge right here. Current share capital, fully diluted. That's $5.15. Nets out to 1 billion. We're at 129, I think, or I think we're actually at 128, but I'm not sure. Obviously, there's some gap from 129 per share to 5.17 per share. If you think there's a 50% chance that Jason's goal will be achieved within 2 years, Magna would be a no-brainer, because that's way more than 100% in 2 years. Can we guarantee it? No. Just risk reward. And to start off with, I think fair value range is still higher than the current price. So I still think there's free risk-adjusted money on the table, not without taking an exploration risk even. So yeah, but of course, it's like if we knew that fair value right now was at 230, let's say just 230. When we get here, if we get here tomorrow, meaning the market was totally rational, that would imply that the value creation pace would be at some angle that would reflect a fair return. I don't know what that would be, but let's say 15% per year. So in that case, yeah, it would be fair value if the market knew that like the let's say something like this, that future value of Magna in 2 years is 298. I think they will have created a lot more value. And again, if you account for that, the fair price is, I mean, supposed to not just priced in what is confirmed, but also the all the future value creation. And I don't think actually this would price that in. That's why in my the piece I did, or the video spreadsheet, I netted it out to closer to probably somewhere around 600 million to 1.2 billion, and I had a mean of 793 million, which is my just my crude estimation of the value that is both confirmed and what I my base case for any future value creation. I might be off on that, but I'm pretty sure I'm not off that Magna is still very cheap just based on what is confirmed today. So that's why I don't care about TA, because I'm after the whole point, or the whole opportunities for this price to current and future value gap to close. So if I had to guess, I would say that Magna will be worth more in 1 year than it is today. If I had to guess, I would think that Magna is worth even more than that in 2 years. And if I had to guess, I would say I'm not even paying for what Magna is worth today. So let's say in 2 years, my base case is that this will be value, the value of Magna. In that case, the opportunities I see it is that the magnet for the share price will be to go up 298% within 2 years. Now, given there's nickel volatility and sentiment volatility, so in reality, I mean, there might be something like this. I mean, in a not so hot market, maybe, if it was a really distressful market, maybe 133 return, which would be super great. That's why I like Magna. In a very hot market, maybe 850%. It's like probably we'll have to have nickel up a bit, or we've made some fat discovery, gone into production, etc. But anything is possible. It's like my base case is simply that I think it's already cheap, so I'm not taking any price to value risk. So automatically it kind of becomes a buy, and if it's large enough, if I don't know another play that has more probable upside than Magna, for example, of let's say 78%, just pick a number, or 100% over the next 12 months, that means Magna would be the best case in that case. And obviously, if I had to choose from let's say a pure beta play, which had a fixed value and there was an 80% gap, I wouldn't get paid to wait. But in the case of Magna, which we assume is creating value every month going forward on average, the opportunity from today to 1 year from now is just going up, while the opportunity in the trading sardine is staying fixed for as long as the eye can see. So if it takes 2 years for sentiment to become alive and revalue to full value, I'd get a 85% return in what did I say? Let's say 2 years. But if Magna's created a lot of value and the market becomes rational, let's say I might be up 565% in Magna. So obviously that's why I prefer cases like this. Margin of safety plus the paid to wait. And of course, it's like when people's like, yeah, I'm gonna get in when all the value is being created. Okay, basically you're betting that the market will not price in any of the value creation. I mean, the whole point is that you're taking a leap of faith now, and you'll get rewarded in case you're fairly accurate. Because let's say you wait and thinking I'm gonna get in 2 years. Thinking that the price will be the same. It's like, yeah, okay, I wouldn't bet on it. Just go on another story. It's like Western Alaska, this would be more of a story like this. Basically that, sure, Western Alaska might be expensive based on what is confirmed. So you're taking you're taking drill risk. Basically, we don't know for sure that they have something that is worth this much. But just based on what they've drilled so far and how CRD systems work, I'm pretty sure that they have at least, let's say 45-50 million ounces of bonanza grade silver polymetallic mineralization. And I expect that to grow a lot. And I've been thinking about some other exploration story. I think this is something to keep in mind, like the pace of value creation. If you have the best, one of the most impressive systems in the world, but you have it's a nuggety system, think Newfound Gold, and you only have one drill rig, even if it is a multi-million ounce gold deposit, that is going to take a long time to confirm. Whereas Western Alaska, for example, which has very high blue sky potential because it appears that it's might be a very, very big system, they're planning to have 3 to 5 drill rigs. Sure, it's the northern, well, it's in Alaska, so you have a shortened field season. But it's like, I think that's, I mean, if they were going to use one drill rig, maybe they could have, I mean, the value trend, this is just this is actually just a support trend. Again, I would just say that yes, I look at technical analysis, but I bought when it broke down here because I thought it was so cheap. So this is more of a interesting thing to look at. It's like, yeah, okay, maybe it's gonna bounce here and I might not be able to get it cheaper, but even if it breaks down, I'll typically be more inclined to buy if I think the case is intact, etc. I mean, what happened here is basically it broke up, then kind of broke down again, then broke up, and yada yada. So it's like, yeah, if it's a fundamental play, which pretty much is the only thing I do, I don't pay too much attention to the technical stuff because that's not where the edge is. The edge is in Western Alaska, for example. They have a goal of ending 2023 with an inferred resource of 120 million ounces AU equivalent at bonanza grades, which would put them on par with Silvercrest, which has over $1 billion market cap. So obviously the idea here is that it's the fundamentals, the coming fundamental change in the company and not some chart which provides the opportunity, because I'm looking at a future where news releases have come out and hopefully their goal will actually be a reality. So in that case, who cares if it breaks down? Now my game plan is, okay, price today versus a future that looks like that. That's a wide price to value gap, even if you have to risk adjust it. Like, I don't know, 50% chance that they'll make it work. So maybe the fair value today is like 500 million or something, or 400 million. That's still, over 100% risk adjusted return in a year. That's double what my goal is. Again, it's like Bear Creek Mining. Look how volatile this stock is. How much do you think traders made in this stock? How much do you think someone who just paid up after the discovery, sure, it might be up 50 to 80 to 100% or whatever, he has bought it, and as long as the story was intact, as long as he thought this was obviously more of a pure exploration story, meaning, yes, you paid up for the discovery hold, but you didn't try to be fancy, you didn't look at this gap here. I mean, this gap never closed. So this gap didn't close either. So again, it's just case in point, I would say. It's like, I mean, let's say you didn't buy, this was one of the biggest revaluations. This was kind of a fat revaluation, and then it went higher. I mean, I don't know if this might be a gap here, which I don't know for sure if that closed. I don't think even this gap closed. I guess that kind of proves my point. It's like, you have a gap here, didn't close. You have a gap here, I don't think that closed. You have a gap here that didn't close. Was close to it, but it didn't close. This gap here didn't close. This, I don't know if this is a gap actually. This gap didn't close. So it's like to say that all gaps, and especially it's like if you think it's cheap, I mean, not only would no trader buy this on the way down because you didn't know it was a bottom, they would not buy the gap ups either. So that's what my point is, that in my opinion, I don't think you make the big money. I don't think the edge is to be a technical trader. Again, I'm just going by my results. So it's like that dude said, you have to be aware of RSI, and like that is absolute, in my opinion, bull crap. Maybe he makes it work, and that's like kudos to him. I think it's total wrong way to play. I mean, if you're a stock picker, it's like why not just trade Bear Creek Mining, where there's like at least no getting paid to wait. Here's like getting paid to be diluted instead. But if you have like some of the most obscene growth cases where it's like, yeah, if I had to guess, value is going to be up in a year. I mean, that's the whole case pretty much. Yeah, okay, I think I'm underpaying today what the value will be in 1 year, which nobody cares about right now. That is literally the edge. Not that you predict every move towards that future. I mean, to me, it's just common sense. Like, how do you actually get an edge? And how do you, again, it's like, how do you play a superior management team? The only way to capture the value creation skills of a value creating team is to give them time. Sure, you could give Great Bear time and not be in the stock, but after they created so much value and you're gonna buy here, I mean, you miss the whole journey. The thing is obviously to be in before all the value has been created and hold it until they can't really create any more value, because then you've saturated the growth curve. It's a mature play. I mean, it kind of matured here already when it's starting to consolidate. Actually, I mean, I pointed this out before. I mean, this kind of looks like the consolidation that's going on in Eloro Resources. And they've just, as Great Bear, they've just created value. I'm just gonna take a look at that actually. This kind of looks similar to this thing here. I mean, it's not a perfect match, but yeah, I mean, I think this, like, wilder evaluations, this one would be here something, up, peak, long consolidation, and value was created all the time. I mean, look at how wrong Mr. Market was according to Kinross. I don't know when this is, like early October, Mr. Market said the value is $13. A few months later, it gets sold for like 28 or 29. So this is where Kinross thought the value was. Obviously, they wouldn't have created this amount of value in just a few months. So maybe at this point when price was here, value was already up here. That's a huge price to value gap. And if you're a trader, maybe you buy the breakout and catch some of that upside. If you're a value investor, it's like, yeah, you think the market is absolutely batshit crazy, you'll be ramping up your buying as price went down and the price to value gap increased. And that's what I think is the case in Eloro, for example. I think value has gone something like, okay, let's not be too, well, something like this. I think as price has treaded water and gone slightly down, I think the price to value gap just keeps on expanding and expanding. And if I had to bet, I would think that this consolidation will close one day, and it's gonna, I mean, depending on how you actually draw, one could say it's a box or whatever. I think this is a similar price consolidation like this, while value has been going up in Eloro. And in that case, again, it's like the opportunity would be much better here than here because more value would have been created. But as a trader, you wouldn't look at that at all. You might get in if it breaks here. So let's say we reckon that fair value, risk-adjusted fair value, is somewhere up here. Let's say 9. As a trader, you'll get in with your typical trading position and possibly make 64% on your 1% position. Let's say you're more of a value investor. Let's say, I don't know, 5% of your junior portfolio, whatever. It's like, yeah, you'll make 159% on a 5% position, then 64% on 1% position, because you were not a trader. You were just well aware of the fact that the price to value gap is increasing. And you think that, hey, on a risk-adjusted basis or an expected return basis, I think there's a big price to value gap here, and I think the price to value closing is a matter of when, not if. While in a trader's mind, it's a matter of if. And also kind of when. But it's like, yeah, again, my personal opinion, fundamentals first, stock picking, price to value gaps, and then just literally have the patience to wait for them to close, because you never know when the market will care. Because in my opinion, if the market would be totally rational, the day of the announcement, it wouldn't close here, the price of Magna. It should close somewhere up here. That obviously didn't happen, and that's why you have an extended opportunity, which I don't think has closed yet. Anyway, hope you got something out of this. Consider me biased. Assume I own shares of all companies mentioned. Assume I might buy or sell at any point in time. Take responsibility for your own actions, not investing advice. And Eloro and Magna are banner sponsors, so consider me biased. Yeah, I own shares of Snow. The same goes for Western Alaska, and I own Snowline as well. Thanks for listening. Hit the thumbs up if you like this stuff. Bye.